Hi, Professor. Can I ask a quick question?
Yep.
Yeah. I'm almost finished with the Amazon and another book that I'm reading, and I wanted to read. You remember, like the book you recommended about like reverse engineering, like
Expectations investing.
okay.
Author is Rappaport, Rappaport. That's one of the authors. He's the easier. Also go to Amazon, type in expectations investing. It should show up.
Okay. Thank you, Professor.
Okay, folks, we're ready here. Everybody's on. So let's get started. Are there any questions before we start? Now, as I said in my email yesterday, I'm sorry for not getting your DCFs back. Any DCFs you sent post Thursday, I will try to get them back to you by the middle of this week. So that's next on my agenda. I have a couple more grading things to do before I get there, but you should be getting your DCFs back in the sequence that I get them now back to you. And I will also, as I send them back, I'll also send you the template that I use to kind of look at a DCF. So you can devise your own kind of testing mechanism when you have a DCF, say, what should I look for? So today we're going to continue on the discussion of pricing. And we're going to start with what we usually do, which is, tests of, do we really know what we're doing when we do pricing? So I'm going to start with a very simple proposition. Now, yes, in the last class, I did mention that pricing is much more common than valuation, that people like to price things, price stocks, price real estate. And if you talk to many analysts who use PE ratios or EBITDA, you ask them, why do you do this? The most common answer you get is that it's easier. You don't have to make as many assumptions, because in discounted cash flow valuation, you've got to make assumptions about cash flows and growth and risk. We don't have to do that in pricing. Jake, what do you think? Do you think that's a legitimate reason for using pricing, that you have to use fewer, that you're making fewer assumptions?
Yeah, I think so, because it'd be quicker to value a bunch of companies in the industry.
So tell me how we do pricing. We compute the PE ratio for a company, we compute the PE ratio for 15 other companies, we compare the two, and then we draw judgment, right? So let's say the PE ratio for your company is 10 and the PE ratio for the sector is 15, and I say your stock is cheaper. Am I also making some implicit assumptions there about the companies I compare this company to?
Well, you're assuming that the other companies in the industry are fairly priced.
And what else?
And that because of that, your company is then underpriced.
And also that they have the same cash flows, growth, and risk characteristics as my company, right? Implicitly, I'm assuming things about cash flows, growth, and risk. So it's not true that we don't make assumptions. We don't make them explicitly. We're making them in the background. And that's what makes it easier, but it also makes it more dangerous, because if you're not careful about those assumptions, they can blow up on you. So today we're going to talk about how do we know what to control for? What do we need to control for to compare multiples? Now I'm going to ask a statistical question. Nick, you're going to help me out here. So let's say I take PE ratios, I graph them on a distribution, basically PE ratios for all companies. Can that distribution ever be normally distributed? Can PE ratios ever be normally distributed? Sorry.
I guess no. I think it's more of a power law kind of thing. Or just
before we go power law, tell me about a normal distribution. What is it that a normal distribution looks like that makes you conclude that a P ratio cannot? When you look at the tails of a normal distribution, what are the extreme values on a normal distribution?
Yeah, there are 3 standard deviations here, 2 standard.
But even beyond the 3 standard deviation, the tail keeps going on and on, right?
Yeah.
Minus infinity to plus infinity. Right?
Yeah.
What's the lowest value PE ratio can take?
0, right?
0. You can't go below 0. So today we're going to talk about what that causes, because that causes statistical problem for us, and especially on a parameter that people use all the time when they do pricing. Which brings me to my final question before we delve into today's topic. So let's say I'm an analyst. I've computed the PE ratio for a software company, it's 12. I've computed the average for the sector, it's 20. And I tell you this stock is cheap. Kind of talked about this. What am I assuming about these other companies? They're just like my company. In what? Every fundamental, cash flows, growth, and risk. That's what I mean about implicit assumptions. That might be true, that might not be true, but the only way to check is to look at the numbers. So what I'm going to do in pricing is actually say, abandon all those theory things that hold you down, about how we think about risk and cash flows. Pricing, it's free form, it's statistics and data. It's kind of funny because we live in a world where big data and crowds are revered, right? Everybody's dependent on big data and everybody trusts crowd wisdom. We pick our restaurants based on what Yelp reviews look like, our movies based on Rotten Tomatoes. And markets are the receptacles where big data and crowd wisdom has been around for the longest. You know what we've realized in finance? Crowds should be respected, but they can make some very bad mistakes. That's a whole basis in behavioral finance. But the nature of pricing is you trust the crowd to get it right. Jacob?
Yeah, I had a question.
Go ahead.
If we can reasonably assume that the companies are similar, then what would the limitations of a price to earnings ratio then be?
The limitations of you can conclude that your stock is underpriced or overpriced given the peer group. But if the entire peer group is overpriced, which can happen, right? Sometimes you can have an entire sector, then you're not going to be protected. You just told me your stock is 20% cheaper than these 15 companies, but all 16 companies are overpriced. You're going to be still exposed to risk. That's the difference between undervaluation and underpricing. Undervaluation, you're buying something based on its fundamentals. Underpricing, you're buying something because other people are paying more for similar things.
Okay.
So let's talk about pricing. Nature of pricing is you need a multiple. So at the risk of insulting you, let me go back to basics. A multiple has a numerator and a denominator. Everybody agree with that? If you have a multiple, here's what needs to go in the numerator. Your numerator always has to be a market set number. Like what? It can be market cap, which is market value of equity. It can be market value of equity plus market value of debt, which is total value of the firm. Or it can be market value of equity plus market value of debt minus cash, which we call enterprise value. All are measures of market value. Numerator is always a market value number. But it's in the denominator that you get the real variations, right? I can divide that market value by revenues. Why? Because I'm desperate. Everything else is negative. The only number that's positive, I can divide by revenues. That's a revenue multiple. But what if you're a pre-revenue firm? I get even more desperate. If you have no revenues, guess what I divide by? I divide by something that I think will give you revenues, subscribers, users, downloads. So I can divide by revenues or revenue drivers. I can divide by earnings. Earnings can be to equity investors, net income. It can be to the entire company, which can be operating income. I can divide by a cash flow. If I'm looking at equity investors, that cash flow can be, if I want to be pseudo-sophisticated, can be free cash flow or equity. After all, we did that with DCF. But remember, we do pricing because we want to keep things simple. So you don't really deal with CapEx or working capital. Here's what you do. You do a half-assed attempt at free cash flow or equity. You take net income, add back depreciation, I'm done. And, or you can divide by cash flow to the entire business, which again, if you want to do it the full-fledged way, you can say free cash flow to the firm because we can do that, but that requires CapEx, working capital, etc. Or you can take operating income and add back depreciation, amortization, which gives you EBITDA. So you got revenues, you got earnings, you got a measure of cash flows. Or you can divide by what the accountant told you your company was worth. Remember, every year your accountant comes up with a number. Your equity is worth this much, shareholders' equity. Or you can take shareholders' equity and add book debt, which gives you the accounting value of the firm. Or you can take book equity plus book debt and subtract out cash, which is invested capital, the same invested capital we used on return invested capital. Numerator is always a market value. The denominator is a standardizing variable. That's what it does. It basically allows you to compare across companies. So I'm going to give you a 4-step process, which if you are religious about following, you will do pricing much better. And here's what the process will start. Start by describing the multiple. I'm sorry, by defining the multiple. And you're going to get insulted because you're going to say, I know what the PE ratio is. I know what the EV, I know you know. But let's say if what you call PE and I call PE, we're talking about the same thing. You're going to be surprised at how many variants there are on these pricing multiples. If you're not careful, you could be talking about 2 different things. Then I'm going to describe the multiple. That sounds, again, very deep, but I'm going to play Moneyball with the multiple. I'm just going to let the data tell me what's high, what's low, what's average. So basically, I'm going to look at the data on the multiple. Third step, I'm going to analyze the multiple. Again, I'm going to go back and use a discounted cash flow model to eke out from the multiple the variables that I think you should be asking questions about. So if I tell you a stock is cheap because its price to book ratio is less than 1, I want you to know what questions you need to ask me to make sure that this stock is cheap, rather than something that just looks cheap. And only then am I going to apply the multiple. Define, describe, analyze, apply. You know what I think the problem is? We're in such a hurry to apply multiples. We want to use them to find good stocks. We skip the first 3 steps, and that is extremely dangerous. So let me start with the first step. When I look at a multiple, and you can think about your favorite multiple, here's the first question you need to ask. Is this multiple consistently defined? Let me explain. Remember I said every multiple has a numerator and a denominator? Here's the very simple rule. If your numerator is an equity value, your denominator has to be an equity value as well. If your numerator is a firm or an enterprise value, your denominator has to be a firm or an enterprise value as well. Sounds incredibly abstract, right? But Rodrigo, help me out here. I'm going to come to you with a multiple. In fact, it's the most widely used multiple in the world, the PE ratio. And I want you to help me break this multiple down. Yeah. When I look at a PE ratio, what's in the numerator? Equity value, firm value, enterprise value?
Equity value.
Equity value. And what's in the denominator? Earnings per share. And it's not just all earnings, it's net income divided by number of shares. So it's an equity. So thank God for small blessings. The most widely used multiple in the world is okay. Sriram, you're next on the dock here. EV to EBITDA, very widely used multiple. What's in the numerator? Equity value, firm value. What is it? What do we measure?
Firm value.
And we're measuring the value of the operating assets of the firm, right? It's market value of equity plus debt minus cash. It's a rough measure of the market value of the operating assets. And in the denominator, you have EBITDA, which is a rough measure of operating cash flow in the company. EV to EBITDA is okay. You say, what wouldn't be okay? Have you seen a price to EBITDA multiple? I've seen it. In fact, out of the 550 equity research reports I told you I collected about 20 years ago, 7 use price to EBITDA. The analyst who invented this multiple to be tarred, feathered, and driven out of the fraternity if one exists. This is a truly awful multiple. But here was the thing that was a bit of a surprise. Out of the 7 analysts who used price to EBITDA, 1 happened to be somebody who'd taken this class 6 years earlier. So I decided to call him. He says, who is this? I said, remember that valuation class you took 6 years ago? He said, vaguely. And I said, it shows. I said, what the heck are you doing? Dividing market value of equity by EBITDA? That's not consistent. He said, no, I'm being consistent. I said, what are you talking about? He said, I use price to EBITDA for all 17 companies in my sector. And I said, that's a very strange definition of consistency. But let me ask you a question. I said, have you been noticing that companies with a lot of debt in your sector keep looking cheap to you? He said, yes, I've been noticing that a lot. I said, have you ever stopped and thought about why that might be happening? Do you see what happens when you use price to EBITDA? In your numerator, you have market cap, right? Let's do a game. Let's assume you borrow 50 billion and you buy back stock. Overnight, the number of shares in your company will drop. Your market cap will actually get smaller because you've shrunk the equity in your firm, but your EBITDA is still your EBITDA, right? The more you borrow, the cheaper you're going to look on a price to EBITDA basis. What that's going to mean is you're going to find companies that look cheap but are really not cheap. They're coming about because you used a multiple that was not consistently defined. But before you feel too superior to the analyst, if you've ever used price to sales, you committed the same sin, right? Because think of what you have in the numerator, market cap. What's in the denominator? Revenues. Revenues don't belong to equity investors, they belong to the whole company. So if you're going to use revenues in the denominator, what should you have in the numerator? If you're doing a revenue multiple, you should never have market cap in the numerator. You should always have enterprise value. You know how many analysts use price to sales? I see it on a regular basis. And they've been able to get away with it for the most part because guess which sector price to sales ratios get used in the most? Do you have any idea which sector price to sales ratios get used a lot?
To be honest, I'm not entirely sure.
It's technology companies. You know why analysts have been able to get away with using price to sales? Because most of these companies have so little debt that they don't have to worry about enterprise value. But it's a dangerous game they're playing. They got lucky by, it was pure accident that they didn't get into more trouble. So is it consistently defined? We'll come back and do more consistency tests. But let me ask you, let's ask a follow-up question. Is it uniformly estimated? You're saying, why do you care? If I'm going to compare PE ratios across 25 companies, they better be estimated the same way for all 25, right? It's the denominator I worry about, not the numerator. The market sets the price, it's demand and supply, but the earnings per share is set by accountants. I used to think that as long as you had the same accounting standards, you were home free. But I've discovered in the last 20 years that you can have the same accounting standards govern 25 companies, GAAP, IFRS, and have different degrees of fidelity to those standards. In other words, companies are not even breaking the rules. They're using the discretion within the accounting standards to be conservative or aggressive. Conservative companies report lower earnings, aggressive companies report higher earnings. Cleaning up for that is part of pricing as well. So is it consistently defined? Is it uniformly estimated? So here's what I'm going to do. I'm going to throw a bunch of examples at you, and let's try this consistency out, layers of consistency. Let's take the PE ratio. Price divided by earnings per share, right? In fact, everybody knows what the PE ratio is. Even Anna Kournikova seemed to know what the PE ratio was. You guys are too young to remember Anna Kournikova, but you've seen Maria Sharapova, right, play? Think of Anna Kournikova as Maria Sharapova without the talent. She masqueraded as a tennis player for like a decade, won nothing, but was in every commercial you could think of. This is about 20 years ago. Schwab runs this commercial. And Anna Kournikova is in the commercial. So she's playing somebody, must have been an actress. She was actually winning. So it's the middle of the tennis match. You know, in tennis, you switch sides every 2 games, so the sun's not in your eye. So they're switching sides in the middle of a tennis match. I don't know why this would come up. But Anna turns to this actress she's playing and says, price earnings ratio is price divided by earnings per share. I guess this is what tennis players say in the middle of matches. And then she went on to say something about preferred dividends that completely went over my head. I remember turning off that commercial saying, does Anna Kournikova really know what the PE ratio is? Is it that simple? Price divided by earnings per share. It's true, the numerator is usually the current price. Though there are some technical analysts who do crazy things with moving average prices. Remember, you can buy or sell at today's price. There's no other price to even worry about. But it's the denominator that you get the real variations, right? I can divide price per share today by earnings per share in the most recent fiscal year, which for some of you is still 2019. It could be earnings per share in the last 4, that's called current PE if I divide by the most recent fiscal year. If I divide by the earnings per share in the last 4 quarters, that's called trailing PE. And the last 4 quarters are going to be pretty deadly because that includes much of 2020 when COVID hit your company. I could divide price per share today by expected earnings per share in the next 4 quarters, which is forward PE. Or I could divide price per share today by expected earnings per share in the year 2029, which is really, really forward PE. You say, why would I do that? Desperation. I'm the biotech analyst. Every company in my sector is losing money. The only tool I know how to use is PE ratios. I'm in big trouble, right? Earnings per share are negative. So you know what I do? I project out the earnings for every company 10 years out, and I divide the price today by expected earnings per share. And you know, and I conclude that XYZ company is cheap because it's trading at 8 times 2029 earnings. You don't even know what to make of that, but it just looks cheap to you. I can divide by earnings per share before extraordinary items, after extraordinary items, before lease adjustments, after. It's amazing how many variations you can get. I remember about a decade ago, I sat down with Cisco, at that time one of the most widely followed stocks in the US market. And I computed a total of almost 40 different PE ratios for that company at a point in time, depending on how I defined earnings per share. And the net numbers range from 14 to 35. You're saying, so what? If you have bias, if you're a bullish analyst on Cisco, you want to convince me to buy Cisco, you know how you do it? You focus on the 14. It's trading at 14 times earnings. If you're bearish, you say it's 35 times earnings. Next time you see two analysts on CNBC arguing about a company, check this out. You'll find that bullish analysts always like to use forward numbers. Why? Because it makes the PE ratio, whatever multiple they're using, look lower. Bearish analysts always like to use trailing numbers because it makes their case of, hey, stocks are overpriced. So PE ratios are consistent. But let's add to this by looking at comparing PE ratios across the sector. Let's assume you're looking across tech companies. Okay? You're looking at PE ratios for these companies, and they all have options outstanding. But different amounts. Some have few options, some have lots of options, some have in the money options, some have out of the money options. This is not a hypothetical. This is going to be true for almost, whenever you look at tech companies. And you're trying to come up with a PE ratio that is not going to be biased by the presence of options. So I'm going to give you some choices, and with each one, I'd like you to tell me what kind of bias I'm going to end up with. What kinds of companies are going to look cheap? Not because they're cheap, but because of the way I've defined my PE ratio. So the first attempt I make is I take the price per share and divide by primary earnings per share. In other words, I take the net income and divide by the actual number of shares outstanding. Which of the companies in this sector are going to look cheap to me? And why? Given that there are big differences in options out there. Raja, what do you think? Which of these companies are going to look cheap? Companies with lots of options or companies with very few options?
I'm not completely sure, but I would guess companies with not that many options.
Let's think about what will happen if you have lots of options. Market knows you have lots of options, right? If it knows you have lots of options, what does it do to your market price? It knocks down your market price. I'm taking that low price, I'm dividing by an earnings per share that doesn't reflect the options outstanding. Companies with a lot of options will look cheap to me because I've divided the price per share, which is low because you have lots of options, by an earnings per share that doesn't reflect those options. I'll end up buying a lot of Cisco in my portfolio because it looks cheap to me. If I go to the other extreme and divide by total number of shares, diluted earnings per share, all options outstanding, then here's the second problem I'm going to run into. Not all options are created equally. If you have in the money options and out of the money options, they have very different impacts. In the money options will have a much bigger effect on your value because they're draining more of your value. So a company with a lot of in the money options will look cheap relative to companies with a lot of out of the money options if you're looking at diluted earnings per share. I won't even keep going down this path. No matter what measure of per share you count, you're going to run into one problem or the other because options are not neat securities. They don't go 0 or 1. So you say, what do I do then? You don't need to do things on a per share basis to get a PE ratio, right? So I could get PE ratio by taking price per share and divide by earnings per share. But you know how else I could get PE ratio? I could take the total market cap of the company and divide by net income. If I do that, I'm getting a much more sensible measure of the PE ratio than using any individual measure. One of the things I'm going to emphasize today is don't trust any of the PE ratios, price to book, EV to EBITDA you see on services. Not because they don't do it well, but you don't know how they do it. They're not very transparent. They'll say, we divide price by earnings per share, but what per share did you use? What count did you use? Primary, diluted, partially diluted. It's amazing how opaque they are on basic calculations. Which brings me to EV to EBITDA multiples. I'll give away my age. When I started looking at stocks in the early 80s, you'd run into maybe every 1 in 100 equity research reports would have EV to EBITDA. PE ratios are dominant. Today, if you walk into any equity research house, anywhere in the world, and you pick up equity research reports, 1/3 to 40% of all equity research is done using EV to EBITDA. So a lot of analysts use it. So I'm going to ask you a question that I often ask analysts who use a lot of EV to EBITDA, and I almost never get the right answer. So you look at EV to EBITDA in the numerator, you have market value of equity plus debt minus cash, you net cash out. And in the denominator, you have EBITDA. So Rebecca, can you help me out here? Here's my question. Why do we net cash out of the numerator?
Is it because it's just kind of like sitting there, it's not adding any
So,
value?
so you're saying it's a wasting asset, it's just sitting there. But then let me ask you a question. Should I be doing that for all of my non-productive assets, or is it just cash that I carve out separately? Because there are other things I might own which might not be. What if I have a business that's not producing much income? Should I net that out too?
No, because cash is kind of like, I guess, the easiest asset to like spend, I guess.
Okay. And what happens to the income you make on cash? Where does that show up in your income statement? It shows up below the EBITDA, right? It basically, do you see where I'm going? The reason we net cash out, you're right, it's a non-operating asset, it's a wasting asset, but the reason we net cash out is very simple. It's because the income from cash is not part of EBITDA. It's a consistency. Because if I'd include, that's why with PE ratios, we don't net cash out, right? We don't do the stance with PE ratios because after all, the market cap includes cash, but we leave the cash in there. EV to EBITDA, we net cash out because the numerator is EBITDA, which doesn't include the interest income from cash, which raises it opens up a Pandora's box. Right? Remember the Tata Motors valuation I showed you last week? This Indian family group company, which got 40% of its value from what? Cross holdings in other Tata companies. You're saying what's special about cross holdings? The income from cross holdings doesn't show up. The minority cross holdings don't show up as part of your operating income. They show up below. So guess what else we should be netting out of the numerator? The market value of those cross holdings need to be netted out because the income from those cross holdings are not part of EBITDA. And then there's a really messy issue. What if I own 60% of another company? What am I forced to do? I'm forced to consolidate, which means I'm acting like I own 100%. So when I look at EBITDA and cash and debt, I'm counting 100% of the subsidiary when in fact I own only 60%. So if I have a controlling interest of a company, I need to actually add back the 40% that doesn't belong to me to get this again. It's a pain in the neck when you have cross-holding companies to even compute the EV to EBITDA. But are you surprised? Because when you did DCF, remember how much of a pain in the neck it was when we did DCF to have cross holdings? Do you think that will all go away just because you switched to an EV to EBITDA? Your problems have not gone away. Whatever problems you had when you valued your company at the DCF, they're out there. You can choose to act like they're not there, but they're always there, even if you do pricing. One final example, and then we'll move on to the next section. So Ryan, you're going to help me out here. One of the big issues running into is real estate has had a really good run in the last year. I mean, the neighborhood I live in, houses are up 12, 15% over the last year. And one of the questions people are asking is, are we in another housing bubble? Right, like 2006 or 2007. And I'll give you one of the statistics that real estate analysts like to use to measure whether real estate is cheap or expensive, is they divide the price of a house by the rental income you can generate from that same house. So I'll give you an example. Let's assume the price of a house is 2 million, whatever neighborhood you've picked. And that given rental rates there, the rental income is 80,000. Net rental income, so net of expenses and stuff. So they divide the housing price 2 million by 80%, and that gives you a multiple of about 25. So they say houses are trading at 25 times rental income. The way housing analysts use this is they compare it across time. And they say 25 times rental income is much, much higher than it was 10 years ago, 20 years ago. But you got to live in the world you're in. Right now, as an investor, you're facing a choice. Should I buy a house or should I buy stocks? So let's assume you want to compare housing to stocks to decide which one is a better bargain for you. So I gave you the example, what I used to look at houses. I took the housing price divided by net rental income. I'm trying to think of what statistic I can use for stocks that will be an equivalent comparison. So Parth, you're going to help me out here. So I've got housing price divided by rental income for real estate as my measure of pricing in real estate. I want to compare to something equivalent with stocks. And I'm going to give you the choice and you tell me whether this choice makes sense. I could divide by compare to price earnings ratio. Would that be a apples to apples comparison?
No.
And tell me why not.
Well, on price, that includes the, okay, hold on. In the example of the house represents essentially the house price represents the chance to take over 100% of the house, and the rent.
And also you took a mortgage to buy the house. The housing
Yes.
price includes both equity and debt. It's closer to enterprise value, right? Because I'm looking at the value of the house, not just the value of the equity in the house. So basically, it's got to be an enterprise value comparison. Everybody clear on that? Because a price earnings ratio, I'm looking at only the equity portion of company. Here, since I'm comparing the value of the house, I'm going to compare it to an EV. What do you think the net rental income is closest to? Sales, EBITDA, or EBIT?
I wouldn't say that it's sales because you said net rental income includes the expenses.
Yeah.
So between EBITDA and EBIT, depends whether you're taking in the depreciation.
I did this because the net rental income is the depreciation on the top of that. It's a tax benefit. So it's closer to EBIT. So if I were comparing this ratio, I would compare it to EV to EBIT. You know what's very interesting? I'll see if I can pull that up for this week's challenge. Is I'll pull up the housing price to rental income going back over time and the EV to EBIT for stocks going back in time. It's a rough measure of, hey, what's more overpriced? Now, maybe that'll give us an indication of when housing is getting out of hand is by looking at that comparison. So that's the first stop, the definitional stop. Make sure the multiple you're using is sound before you start doing more fancy stuff. My second stop is purely statistical. One of my favorite books is Moneyball. It's a Michael Lewis book. Now, those of you who've read the book or you watched the movie, right, with Brad Pitt in it, it's a story of the Oakland A's. Any A's fans in this class? No A's fans? Okay. The story of the book is actually very simple. This guy called Billy Beane is hired as GM for the Oakland A's, one of the youngest general managers ever hired by a baseball team. And he comes in, he does what traditionally baseball managers have done, which is listen to these old scouts tell him what to do. These scouts are 60, 70 years old. They've been around baseball forever. And they come in and say, you know what, I've been around baseball forever. And you should sign that guy. Why? Because, based on my 50 years of history, when he swings the bat, that little glitch he does, that reminds me a lot of what Mickey Mantle used to do. And trust me on this one, he's going to be a great hitter. So you listen to this guy, you sign this guy for $25 million, he strikes out like 50% of the time. And that's what Billy Beane discovered. He discovered these scouts had no idea what they were talking about. They made up all these rules and those rules didn't seem to work. And he said, finally, why am I listening to these guys? They seem to have no idea what they're talking about. Why don't I let the data tell me who I should be signing? And if any of you are baseball fans, it's a sport immersed in data. Every pitch is recorded, right? Every out is recorded. Every play is recorded. And everything is in the data. He said, why am I letting these guys tell me who's going to get on base? So I'll give you one example of a player he signed. I'm a Yankee fan, and I hate this guy with my entire body, a guy called Kevin Youkilis. So Red Sox, he was a first baseman. And you know why Billy Beane signed him? Because he looked at the data and he said, this guy does, if you get a chance, you go on Google and you pull up a picture of Kevin Youkilis swinging, he looked nothing like a top baseball player. He had this very awkward stance. He wasn't built like a baseball player. He did nothing that traditionally successful baseball players did. But here's what Billy Beane noticed. When he looked at the data, he noticed that this guy walked almost half of the time. If you have no idea how baseball is playing, so what's the big idea about walking? Walking means you get to first base. You know what? A hit and a walk are equivalent in terms of getting a guy to first base. In fact, he renamed him the God of Walks. And he said, you know what? I'm going to sign this guy because the data tells me he gets on first base. And if you get on first base, your inning is off to a much better start. And it was an incredibly successful signing. In fact, he built an entire team based on data. That's what Moneyball is about, using the data to override these rules of thumb and these people walking around saying, this is cheap, this is expensive, this is what you should be doing. You see how Moneyball and the stock market kind of play out? Stock market is full of these rules of thumb. They come from these old grizzled analysts. And this is what I've always been doing. Trust me, 10 times earnings is cheap. 6 times EBITDA is cheap. 1 times book value is cheap. And the pushback is if you have the data, why would I need these guys to tell me what's cheap or expensive? So I'm going to start by playing some Moneyball. I'm going to show you the histograms, the distributions of multiples. And we're going to ask some basic statistical questions. So at the start of every year, I actually compute the pricing multiples for pretty much every publicly traded company in the world. So all 45,000, I do PE ratio, EV to EBITDA, EV to sales, price to book, pretty much every multiple that's ever computed. I do it for every company. And then at the start of 2021, and just as I have for the last 30 years, I put up a distribution, a histogram. Remember histograms from statistics? It's not fancy. I count the number of companies, PE ratio 0 to 4, 4 to 8, 8 to 12, 12 to 16, and that's the distribution. So this is the distribution of PE ratios for US companies at the start of 2021. You're saying, why are there 3 columns? One is current PE, which is at the start of 2021 is based on 2019 earnings, because that was the last fiscal year. The second is trailing PE, which for most of these companies through September 30th of 2020. So it's a 4 months ending then. And the third is forward PE, based on expected earnings from September 20 to September 2021. With every one of these measures of PE, notice something? There's a peak to the left and a tail to the right. The PE ratio can't be less than 0, but it can be well above 100. In fact, I've arbitrarily stopped 100, but the tail would keep going and going and going. Again, you think, who cares? I'm doing investing. This is statistics, is it? In fact, when I compute the statistics, the descriptive statistics on PE ratios, you see the results of this distribution. For instance, if I told you the average PE for US stocks is 110, you'd freak out, right? But you know what? Technically, that was what the average PE was. At the start of 2021, the average PE for US stocks was 110. But before you freak out, remember your statistics class. This is an asymmetric distribution. All the outliers on one side, an average is the least reliable number on the face of the earth. I don't know about you, but I remember my statistics professor saying, if you have an asymmetric distribution, never trust the average, use the median. It's the same reason we use when we talk about betas, use the median, not the average. The median PE is 18. So that's quite a difference. Average is 110. Remember, the median is the 50th percentile. Saying, why is it so different? The answer is easy. The highest PE at the start of 2021 was a company with a PE ratio of 36,157. See, that must be one highly priced stock. It was actually trading at $8. The earnings per share dropped to a fraction of a cent. But here's an interesting number that I want to latch onto. There were 7,584 firms that were US companies on Capital IQ. So I use Capital IQ just like you. But there are only 2,780 with PE ratios. So what do you think happened to the other 4,800 firms? Derek, how come I lost 4,800 firms and I tried to compute PE ratio?
They have negative earnings.
They have negative earnings per share. And you can't even blame 2020, right? That's 2019 earnings for most of them. 2/3 of US companies were money losing. You're saying, what's the big deal? You still have 2,780. Remember in statistics, we talk about bias in samples. Have I created a little bias in my sample? Absolutely. Why? Because I didn't throw out 4,800 random companies. I threw out the smallest, the riskiest, the most distressed companies from my sample. In fact, as I go from current to trailing to forward PE, I lose another 420 firms. You know, I lose it for forward PE. What do I need for forward PE? I need expected earnings in the next 4 quarters. The only companies I can get those for are companies tracked by analysts. We create biases in the most subtle ways by the multiples we use and how we choose to define them. So be careful. I mean, people keep, I see people using average PE, average EV to EBITDA. They don't talk about the sample bias, but this is a statistical problem that could create huge biases in your analysis. Until about 20 years ago, I used to do this just for US companies. And then I end up in Mumbai or Sao Paulo, and I'd show that distribution for the US. And some old analyst would put up his hand and say, no, it doesn't look anything like that in this market. And I said, how do you know? It's a gut feeling. And I got sick and tired of Brazilian analysts and Indian analysts saying, trust me, it doesn't look anything like that here. So I said, no, the best way against this is to look at the data. So 20 years ago, I went from US companies to global companies. I basically said, I've got to expand my search. And here's what I do every year now. In addition to doing the histogram for US stocks, I do the histograms for other parts of the world as well. This is the entire world in terms of PE ratios in one picture. Notice I've broken it down into the US, Europe, emerging market, Japan, Australia, New Zealand. Every single part of the world, you get a peak to the left, the tail to the right. This is not a US market phenomenon. It's global. Are there differences across markets? Of course. And the best way to see what the differences is, look at the distribution. So African stocks, the median PE is about 29, and about 40% of companies are money-losing companies. So compare across markets. You know what the cheapest market at the start of 2021 looks like if you just focus on PE? The median PE is lowest in Eastern Europe and Russia. Don't do anything crazy and sell all your stocks and buy Eastern. But you can see if I just compare based on PE, the markets that are going to come through. The market with the highest percentage of money-losing companies is the US, with almost 68%. Actually, it's Canada with almost 82%. And that's because Canada has a lot of commodity companies, and 2020 was just deadly for those companies. But the US is way up there in terms of percentage of companies losing money. That's what the data is. There's no theory here. We're just making comparisons across markets and just bringing in the data to make those comparisons. Now, once in a while, you will get a number that pops out at you and say, what's going on there? I remember in 2013 when I did this, the number that popped out at me was Japan. The median price to book ratio for a Japanese company, January 2013, was 0.67. Now, this isn't Russia. It isn't Brazil. I can't say it's country risk, right? That's the year I actually bought a Japan ETF at the start of 2013 because I couldn't explain it. I said, this looks really low to me. I got lucky that year. But one of the advantages of comparing across regions is if something sticks out as different, you can ask, what's going on there? And finally, this is a great way to contest rules of thumb. I remember about 15 years ago, I was on a panel discussing LBOs, and I was a lot of private equity and LBO guys. And I said, look, I know you guys do LBOs. I know you know your business really well, but I'm always surprised at how shallow your valuations seem to be, that you don't really seem to dig very deep. And one of the lead PE guys, he was actually head of one of the leading LBO outfits, and said, well, that's easy. We can tell when companies are cheap. It's easy to spot. And I said, really? He said, well, any company that trades at less than 6 times EBITDA is cheap. I said, it's that easy, just 6 times EBITDA? I said, yeah, it always works. So I bided my time. And every year, one of the things I do is I do a distribution of EV to EBITDA multiples. In January 2010, I did this distribution for US companies. And guess what? In January 2010, half of all US companies were trading at less than 6 times EBITDA. I remember sending this graph to him and saying, is this still cheap to you? Half the market looks cheap to you? The point I'm making is, why are we using absolute values for rules of thumb? If you have the entire data, what's cheap? Look at the 25th percentile, right? It'll obviously be different in different markets, different at different times, but the data should always be what drives what's cheap or expensive, not some historic norm. We picked a number, who knows when, 1960s, and you're stuck with it still. Sriram, I'm sorry, you had a hand up and I kind of talked past you. You have a question or a comment?
Sorry, I think the chart, not the chart, but the table on 16 might be incorrect. Just because like the 75th percentile matches the 90th percentile.
Oh, you know what? You're right. I will check that because that shouldn't be true. I think I've messed up on the 90th percentile. No. But the rest look
I think
okay,
it's just
right?
shifted one because the median is also 40 for the US and the previous thing that's supposed to be the 3rd quartile. So.
Let me check the data, because you're right. There shouldn't be that much of a variation. But let me check it out. But that's a good point. 75th and the 90th definitely shouldn't match up. So now you guys are ready. You have everything that I need to. I'm going the wrong way. Right? Let's talk about what it is that drives different multiples. So with any multiple, there are two questions I want to ask and answer. What are the fundamentals that drive this multiple? And second, how as those fundamentals change, will the multiple change? Let me explain why this matters. Let's say you're comparing PE ratios across 20 companies. As I said, you can't just pick the company with the lowest PE ratio, right? Because strange things could be happening. You're saying, what do I need to control for? I'll tell you what it's going to be, and I'll explain why these three variables pop up. You have to put control for differences in growth and earnings, differences in cost of equity, and differences in payout ratios. Sounds very specific. It sounds almost suspicious that I came up with these three variables. I'll explain how I came up with those three. And I can go further. I can tell you that as growth goes up, PE will go up. As payout ratios go up, holding all its constant, PE should be higher. And as cost of equity goes up, the PE ratio should be lower. So let's see how this plays out and why I came up with those three variables. It's a very simple analytical device. I go back to a very simple discounted cash flow model. So if it's an equity multiple, I actually go back to a dividend discount model because I want the algebra to be simple. I go back to a stable growth dividend discount model. And then I divide both sides of my intrinsic value model by whatever variable I'm trying to scale to, earnings, book value. I can tell you what drives a PE ratio, price to book ratio. You name the equity multiple, I can tell you what drives that multiple using that very simple device. If I come to you with an enterprise value multiple, EV to sales, EV to invested capital, here's what I'm going to do. I'm going to go back to a very simple EV discounted cash flow model, free cash flow of the firm divided by cost of capital minus the growth rate. And I'm going to do exactly the same thing, divide both sides by my scaling variable, and I can tell you what drives EV to sales, EV to EBITDA. This is a trick you're going to see me play over and over again, but I'm giving away the game. Equity multiple, equity model, firm multiple, firm model. And I'm going to do the algebra to drive what sets that multiple. So let me at least give you a sense of how this works using the PE ratio. Again, most widely used multiple in the world. Let's think about what it is that drives the PE ratio. So I'm going to go back to the simplest equity valuation model that I know of, a stable growth dividend discount model. Value of a stock is expected dividend next year divided by cost of equity minus the growth rate. It's called the Gordon growth model, right? It's been around almost 100 years. Well, if I have an equation, I can divide both sides of that equation by a constant and it still stays an equation. So if I divide both sides by earnings per share, here's what I end up with. Price divided by earnings per share makes it PE. Dividends divided by earnings per share gives me payout ratio. The price earnings ratio for a mature dividend paying firm is a function of the payout ratio, cost of equity, and growth rate. You say, what if I don't trust my company to pay out what it can in dividends? Very simple, replace dividends with free cash flow equity, which is potential dividend. You have the drivers of the PE ratio for a mature company. Payout ratio, cost of equity, and growth rate. Those are the three that I said you need to control for. It's not magic. It comes right out of this way. You say, what if I have a high growth firm? Well, I can do a high growth discounted cash flow model, right? Now, normally you don't see this as an equation because we build this in spreadsheets now. But let's assume you are valuing the company in a two-stage dividend discount model. You know how we value the company? We project the dividends during the high growth phase, and we project a terminal price, and we discount them all back. This equation looks daunting, but the first part of this equation is just the present. It's a growing annuity, and I'm using it to compute the present value of the dividends during the high growth phase. That's the first part of the equation. The second part of the equation is just the present value of my terminal price. I'm writing out what we usually have in an Excel spreadsheet with 5 columns or five rows and 4 columns in one equation. You say, why would you want to do that? Well, there's an advantage to actually stating things more compactly, which is what mathematics allows us to do, right? You don't have the luxury of that many lines and that many columns. You can write out an equation. But here's the even better part. If I divide both sides of this equation by the PE rate, by the earnings per share, I end up with the PE ratio for a high growth firm. And I'm going to list the variables that drive the PE ratio for a high growth firm. And I want you to think about the variables that drove the PE ratio for a mature firm. The PE ratio for a high growth firm is a function of its payout ratio, its cost of equity, and its growth rate. Sound familiar? It's exactly the same variables that I got for a mature firm. The only thing that's different is I compute them twice, once for my high growth phase and once my stable phase. This is called an intrinsic PE. And I'll tell you something, don't try to plug numbers for your company back into this model. It's pointless because you've already done a rich DCF. You don't need to do this, but it tells you the variables that drive a PE ratio, and that's what you want to take out of this equation. So let's try this on a hypothetical company. So you have a high growth company. How high growth? For the next 5 years, its earnings are going to grow at 25% a year. And after year 5, its growth is going to be 8% forever. For the next 5 years, the payout ratio is going to be low. Why? Because they need to reinvest to grow. So they're paying out very little. But after year 5, that payout ratio jumps to 50%. Let's assume your beta is 1. It's the average risk company in both periods. If I gave you the risk-free rate and risk premium, your cost of equity is 11.5%. So think of what I've given you. I've given you the growth rate, the payout ratio, and the cost of equity for both the high growth and the stable growth periods. I went into the equation on the previous page and I plugged in the numbers, 20% payout ratio, 25% growth, 11.5% cost of equity. That's a high growth phase. 50% payout ratio, 8% growth, 11.5% cost of equity, stable growth phase. I work through the numbers. I come up with a predicted PE of 28.75. So what do I do with that? Think of that as an intrinsic PE. If I valued the stock with a two-stage dividend discount model, that's what my PE should be. It's not high, it's not low, it's a fair value. So let's say I give you that recommendation. The stock's trading at 28.75 times earnings. You go buy the stock, it's fairly priced. You buy it. What's your nightmare when you buy a high growth company? You paid a high PE for the high growth. But what's your nightmare? You could wake up tomorrow and realize the growth is a mirage, it's gone. There's a surprise of some sort that tells you were wrong. So let's see what happens if you have that surprise. One of the nice things about creating a hypothetical company is I can keep everything else fixed and change only one thing. So what I did here was I kept everything else fixed and changed the growth rate for the next 5 years. Remember my base case was 25%? I said, what if it's 20 or 15 or 10 or 5? What if it's lower than expected? Or what if it's positive surprise, 30, 35? No surprise here, which is if you get negative surprises, growth is less than expected, your PE ratio decreases. If it's greater than expected, your PE ratio goes up. You're saying, why are there 4 columns? I looked at 4 interest rate scenarios. My lowest interest rate scenario was 4%. It's a very different time and age when I did this. 4% sounded low to me. And a high interest rate scenario is 10%. Under every interest rate scenario, my PE ratio gets lower as my growth rate gets lower. But here's the interesting distinction. As my risk-free rate gets higher, the effects of a surprise get lower. The PE ratio becomes less and less sensitive to surprises about earnings growth as my risk-free rate gets higher. So I have 2 questions. One is, intuitively, why is that happening? Why, as my risk-free rate goes up, is my price-earnings ratio getting less sensitive to surprises about growth? Riju, you want to try? Why, as my risk-free rate goes up, am I getting less sensitive to surprises in both directions about growth?
Probably because your earnings are already getting discounted at such a high rate.
Yeah,
because your
in fact,
cost
that's a
of
very
equity
good point.
is.
Yeah, so let's think about it. What's the value of growth? It's all in the future, right? I expect you to make cash flows in year 6 and 7 and 8 and 9 and 10, right? So as risk-free rates go up, what happens to the value of that growth? It starts to get lower. In fact, let's go to the extreme scenario. Let's say we're in Brazil in 1991. Interest rates have gone to 5,000%. What's the value of future growth? 0, right? Basically, why am I 5,000%? I'm just discounting everything. What if I come and surprise you and say, I'm going to have twice the growth you thought I was going to have? You're going to say, I don't care. Half the growth, not a big deal. As interest rates rise, the value of growth decreases because it's all in the future. Now, let me ask you the second question. What kind of world do we live in right now? A low interest rate world or a high interest rate world? at least in the US and Europe, we're in a world with really low rates, right? And you know what this graph is telling you? This world, earnings surprises matter a lot. And think about how you get the earnings surprises. It's in earnings announcements. Last Friday, Tesla announced that it sold 181,000 cars or something in the last quarter. The price is up significantly today. Am I surprised? Not in the least, because that surprise, because it was a positive surprise, is going to push up prices. GameStop a couple of weeks ago announced a negative surprise that it came in with growth of 21% or 27%. You think that's still good, but it's still a negative surprise. The price dropped tremendously. When interest rates are low, surprises about growth are going to have a much bigger impact because growth is a much bigger part of your value. So be ready for a rocky ride in terms of earnings reports, right? Because as long as the reports are good, you're going to see big jumps up in the price, but the bad. This doesn't mean the market's gone crazy, because that's what people conclude. Oh, market's crazy. Why is it jumping around? It's because when rates get low, this is the dark side, which is prices will get more volatile, and they will get more so for growth companies than for mature companies, because the surprises will affect the value more. Now, the second question I asked was, I took that example and I looked at what happens to the PE ratio if I changed my beta. So my beta, my base example, I used a beta 1. Here I've looked at betas less than 1 and betas higher than 1. The intuitive part is as my beta rises above my expectations, as I get riskier, the PE ratio gets lower. So that's actually a good insight, right? Two companies, same growth rate, the higher risk company will have the lower PE ratio. But I'm going to put you in the spot of a CEO running a company. You're running a high growth, high risk company. In fact, your growth rate is 20% and your beta is 2. So right now, that's where you are, the purple, but 8 times earnings. And you're very, very disappointed. You want to trade at a higher multiple of earnings. What are the 2 ways you can go for a higher multiple? One is you can try to pump up your growth rate. But you're kind of stuck, right? Because you're stuck in this last column because you're such a risky company. You can go to 25, 30%, but your PE ratio is going to be almost sticky. It's not going to move much because risk is weighing you down. That's the other thing you could do. Stop trying for more growth and try to make yourself a less risky company, in which case you're moving across this graph. Look at how much more payoff you get from your effort if you reduce risk rather than go for higher growth. It's an obvious lesson, but it's amazing how difficult it is to get this lesson through at high growth companies. Because high growth companies, you're so focused on growth and getting that extra 1% growth that you forget what the payoff on that growth is. In many cases, the payoff is greater if you focus on growth less and risk more as you get to a point in your life cycle. To me, the most impressive part of Amazon's history was what they did in 2001. Not what they did when the glory time, when they grew, but what they did in 2001 was when the dot-com boom bust. You know what Amazon did early in that year? They issued $2 billion worth of bonds, and they kept it as cash. You think that's stupid. Why would you do that? It saved them. It saved them because the dot-com boom bust, the entire economy shrunk, and that $2 billion allowed them to survive and come back 2 years later. Sometimes focusing on reducing risk is far better than focusing on going for higher growth. So here's what I'm going to do. I'm going to play the role of a naive analyst, and I'm going to put out these recommendations that are horrifically bad recommendations, but I want you to be the one shooting me down, telling me what I've missed. So let's start very easy. I'm comparing PE ratios across markets. And I told you, I'm a very naive analyst. I think low PE is good. I should just invest in low PE. So this is in March 2014, just before the Russia-Ukraine incident that some of you might remember, many of you might not. It's a very risky time for Russia. And these are the PE ratios for stocks. And Russian stocks looked incredibly cheap. So you ready for my recommendation? I say you should sell everything you have and buy Russian stocks. They're trading at about 3 times earnings. What am I missing, Ritik, when I say that? What is it that explains the 3 times earnings?
Professor, you calling me?
Yep.
Do you have to consider the different ERPs between the countries and the different risk factors associated with their
Basically, it's the
currencies?
fact that risky countries will have low PE ratios, right? Venezuela is the cheapest market in the world now. Do you really want to sell everything and buy Venezuelan stocks? I don't think so. Comparing PE ratios across markets, you can't just stop at the PE ratio. You got to bring in differences in country risk. You got to bring in differences in real growth. High growth economies should have higher PE ratios. You can't just stop at the PE ratio, right? So here's what I did, and this is from an even older example. June of 2000, I collected the PE ratios for a bunch of different emerging markets. And again, I'm going to play the role, if I were a naive analyst, I'd say, look, take all your money and buy Turkish stocks. 12 times earnings is really low. But I've given you information, interest rates, real growth, and country risk. One of the most useful exercises to go through when you look at a multiple is to look at your perfect combination. A company that you would like to put your money in where everything is working in your direction. Let me help you here. If you wanted to pick a cheap country here, you want a country with a low PE, right? Because that's cheap. Would you want low growth or high growth? What would make you happier? I would say high growth. You want high growth to go with low PE. Low risk or high risk? Well, obviously, low risk is so much better. So low PE, high growth, low risk. And would you like low interest rates in that country or high interest rates? I'd say low interest rates because then you don't have inflation weighing you down. So you basically want a country with low PE, low risk, high growth, and low interest rates. You're saying, what harm, what chance do I have finding something like that? No harm looking. In this case, there are no obvious mispriced countries like that. But here I can use statistics. And this is where you're going to see me fall back on statistics. When you have different things pulling in different directions, there's only so much you can do by eyeballing the data. So I took that table you saw on the previous page. I made my PE ratio my dependent variable, and interest rates, real growth, and country risk my independent variables. I ran a regression. Remember, it's a multiple regression. I'm going to go through the coefficients and you tell me whether the coefficients make sense. I found that countries with higher interest rates have lower PE ratios. Kind of makes sense, right? I found that countries that are growing faster have higher PE ratios. Again, higher growth is good. And I found that countries with higher risk have lower PE ratios. But it's a statistical relationship. I want to see how strong it is. The R squared is 73%. That's not bad. I'm explaining 73% of the variations. I should probably have reported the T statistics on these as well, and they were all statistically significant. But you're saying it's not a statistics class. I'm an investor. Who cares? You know how I can use this regression? If I asked you to use Argentina, if you look at Argentina, the previous page, it's a 14 times earnings. That looks pretty low, right? You say, is it cheap? Rather than just compare Argentina's PE to the rest of the countries, here's what I can do. I can take Argentina's interest rates, Argentina's real growth, and Argentina's country risk, put it into the regression, and I get a predicted PE based on the regression. You say, what does that even mean? Given Argentina's interest rates, growth, and country risk, its PE ratio should be 13.57. Its actual PE is 14. Now, when you have a regression with an R squared of 73%, your predictions come with a range around them. It's not a precise number. And it turns out that 14 is within that range. In fact, any regression package will give you the range and say, hey, 14 is different from 13.57, but not different enough for you to do something. Brazil had a PE of 21, but its predicted PE was 18.55. That difference was outside the range that you'd expect. Again, I'm not going to do anything crazy, but I would put more money than, Brazil is overvalued. I take my money out of Brazil and find a market that's more undervalued. Brazil is overvalued. Argentina is fairly valued. And I would do that for every country. A lot of global portfolio managers face this question at the start of every year. Which market should I allocate my money to? Should I put more money in India, less money in China, or should I put more money in? So this is a way of breaking the tie by looking past PE ratios at the fundamentals that should be driving these PE ratios. If you get a chance, I'll send you a couple of links. You can download the updated data on PE ratios across emerging markets and see if you can explain differences across markets using fundamentals. Which brings me to US stocks. Now we're in this very strange place, right? The S&P 500 crossed 4,000 on Thursday. For the first time in history. Today it went up even more. Stocks have clearly been on this run that doesn't seem to have any end to it. And it's scaring people. And one of the metrics that's scaring people is the PE ratios that stocks trade. So in this graph, I've computed the PE ratio for US stocks. So the first 4 columns are all PE ratios for US stocks. You're saying why they're 4? Because it depends on how I measure PE. The first is this traditional PE. So the start of 2021, the PE ratio for US stocks was 27.19. So that's based on aggregate price and earnings. And clearly it's much, much higher than it's been historically. If you look at normalized PE, where I look at a 10-year average, because you could say 2020 is what's pushing up the earning. Okay, fair enough. If I look at 10-year averages, the PE ratio is 31.39, still much, much higher than my historic norms. Then you say, what is this Cape and Schiller PE? It's kind of fanciful versions. I think it's just, the added icing here doesn't add much to the number, but they take 10-year averages, they do some inflation dance around them. It's kind of inflation adjusted. But no matter how you define PE, clearly PE ratios at the start of 2021 were much higher, are much higher than historical PEs. This is the basis for people who claim stocks are overpriced and we should be selling stocks. You know why nobody's listening to them? Because they've been saying this for the last 10 years. The PE ratios for US stocks have been higher than historic norms for almost more than a decade. Now, there's a reason, and I've always had issue with this PE ratio based metric, is if you don't invest in stocks, you got to invest somewhere else, right? And if you think about financial assets, if you're not investing in stocks, what do you invest in? You invest in T-bonds. Could I compute a PE ratio for a T-bond? Let's say you have a bond with a 4% coupon rate. What's your price? You paid 100. What do you get as earnings? $4. 100 divided by 4 is 25, right? Think of that as a T-bond PE. Nobody does it, but I could do it, right? And in the second to last column, that's what I've done. You know what? Stocks look overpriced relative to history, but relative to T-bonds, here's what I'm getting. I'm paying 100 times earnings on T-bonds. Remember, the T-bond rate was less than 1% at the start of 2021. This is why looking at PE ratios led you into a dead end. Because interest rates are so much lower now than they've been historically that comparing PE ratios across time leads you into this dead end of saying, I really don't know what to say. So I'm going to try. I actually took the Schiller PE because Robert Schiller obviously won the Nobel Prize for Schiller PE and irrational exuberance and why he thought stocks were overpriced. And I graphed it against the T-bond rate, T-bond PE. So basically, I've compared stock PE to bond PE, and I've computed the ratio of the two. So I could actually make a bullish case based on Schiller's own numbers. I could say, you know what? The PE is higher than it used to be historically, but relative to T-bonds, you're actually getting a bargain on stocks at the start of 2021. I've had this graph on my website now for about 5 years. Those of you familiar with Schiller's work, about 6 months ago, Schiller actually brought in a T-bond PE. He actually made it look like he'd invented this, that he'd come up with this modified version. Okay, but basically he's saying, what I'm telling you doesn't seem to be working. So let me bring the T-bond PE in and say, oh, you know what, stocks could be. So right now he's having his cake and eating it too. He's saying stocks could be overvalued on a PE basis, but relative to T-bonds, they could be undervalued. It's nice to be able to tell the world stocks could be undervalued and overvalued. You know why? Because no matter what happens, you're going to be right. This is what I mean about being opaquely right. Stop dancing around these things. I can't buy and sell stocks at the same time. Clearly, T-bond rates matter. So I'm going to do what Schiller did, but I'm going to try to come up with a conclusion. And to do this, I'm actually going to take the PE ratio and invert it. It's called the earnings to price ratio. It's called the earnings yield, widely used. Right? So if your PE ratio is 25, your earnings yield is about 4%. So what you have in the brown line is my earnings to price ratio. What you see in the blue line is the T-bond rate. If I just stop there and asked you, do the two lines seem to move together? Obviously they do. You say, what is this gray line at the bottom? That's a difference between the T-bond rate and the T-bill rate. You know what it measures? The slope of the yield curve. You're saying, why do I care? Because markets seem to freak out, right? You know when they freak out, when the yield curve gets flat or downward sloping, you see these stories come up, the world's going to end, the economy is going to go into recession, markets are going to collapse. So I said, okay, let me take the conventional wisdom and let's see what the linkage is. So I did some basic statistics. Again, notice I'm drawing on statistics a lot more than I do on financial theory. When you do pricing, it's all about the data. It's not about what the right thing to do is, it's what's working. What do I do to explain markets? So what I did first was a correlation matrix between earnings to price ratios, T-bond rates, and the slope. And guess what you find? No surprise, the earnings to price ratio and the T-bond rate are very closely linked up. When T-bond rates go up, the earnings to price ratio goes up, which means PE ratios go down. When T-bond rates come down, earnings to price ratios come down. So a lot of the expansion in PE ratios you've seen in the last 12 years is purely driven by much lower interest rates. If you look at the slope of the yield curve, the relationship is much weaker. So you go from 0.68 correlation to 0.12, but it's negative, which means the more upward sloping your yield curve, the lower your earnings to price ratio, which means that stocks do much better when you have an upward sloping yield curve than when they're flat or downward sloping yield curves. But I still want to answer the question, are stocks over or undervalued, right? So here's how I decided to do it. I took the data that you just saw and ran a regression of the earnings to price ratio for the S&P 500 against the T-bond rate and the T-bond rate minus the T-bill rate. So the R squared is about 45%. Not amazing, but not bad. I'm just explaining a big chunk of the variation. Clearly, T-bond rates matter. Every 1% increase in T-bond rates increases my earnings to price ratio by about 0.55. And every 1% increase in the slope of my yield curve reduces my earnings to price ratio, but I'm going to be a little more cautious. The T statistic on that is not significant anymore. You see, what do you mean anymore? Until 2008, the slope of the yield curve seemed to matter a lot more to markets. Something's happened since 2008, where investors seem to care less about the slope of the yield curve. And I'll tell you what I think has changed. I mean, if you think about the slope of the yield curve, this is one of the few things that the Fed can have an influence on, right? Because you can drive down the T-bill rate. When your T-bond rates are 5%, you have a lot more leeway as the Fed. You can make the rate much lower, you can make the rate much higher. But if your T-bond rate drops to 1%, it's become a one-sided game, right? How upward sloping can your yield curve get when your T-bond rate is 1%? It kind of flattened it out. In a strange way, as rates have come down, the Fed has become less effective in markets. It goes against the conventional wisdom of it's all about the Fed, the Fed, the Fed. You know what? If you look at the last 12 years, the Fed has less influence in markets in the last 12 years than they did before 2008. And that's what this regression is telling. So I'll leave you with a task. What's the T-bond rate today? Anybody know? It was like 1.75% on Friday, I think. Check it out today. Check the T-bill rate today. Put the numbers into this regression. Get a predicted earnings to price ratio today. And then what do you do with it? You invert it. That should be a fair PE for the market today compared to the actual PE. If you really want to use data to tell me whether stocks are overpriced or underpriced, don't compare the PE ratio today, what it used to be 5 years ago, 10 years ago, 20 years ago, compared to what the PE ratio should be given where rates are today. So if you get a chance, try it out, because I think it's the best antidote to all these people throwing things like stocks are expensive, PE ratio is 37. No, it doesn't make much sense to just look at PE ratios standing alone. You have to bring in the level of rates. You have to bring in the term structure. You have to dot your I's and cross your T's to make that final conclusion. Okay, so I'm going to stop with that. When I come back, we're going to continue with this naive analyst. So kind of get ready for more examples where I do stupid things. And I think you have the tools now to kind of stop me when I do these things and say, you know what, you're missing this, you're missing growth. And that's the essence of pricing, is to be able to push back. When somebody says, this is cheap, you're not just falling in, okay, the PE ratio is low, it's cheap. You're asking the right questions. Okay, so that's it for today. I'm going to stop my share. If you have any questions, I'll hang around for a couple of minutes and you can ask me those questions.
Thank you, Professor.
You're welcome.
Thank you, Professor.
Thank you.
Take care. I'll see you Wednesday.
Thanks, Professor.
Take care. Bye.